What's up, guys? I'm Seb from FX Cartel. If you're here, you're probably interested in the trading market and specifically the Forex market, and you're in the right place because I've got 10 years of experience and a successful proven strategy. And I'm doing this video for you today to help you develop and improve your skills with my latest tips and tricks on the market.
Alright guys, so in this next part we are going to see how to scale in a possible trade and how we can scale out. So what is scaling in the trade? So scaling in a trade affects zone of interest that will be too big for your usual area that you build up with vertical strategy, so using confluences. So say for example, you usually target an area of say 30 pips where you're trying to have as many confluence as you can. This is your strategy. This requires no scaling in. It usually involves you placing a pending or looking at the zone, placing an alert. Depends the way you are trading with zone of interest, but usually it means that as soon as you enter the zone, you take the trade and you let the trade unfold. But sometimes it happens that these zones of interest are way bigger than your usual margin that you allow for an area. So let's say I like to have 30 pips area, which is what I like to have. But sometimes I see an awful lot of confluences as per the vertical strategy. And if you look at the whole thing, they do not fit in that 30 pips area. There's two options when this case scenario unfolds. And one of them is very simple, that zone of interest is deemed untradable. So you do not take trade from it because it's too big and you don't want to have to figure out which spot price is the spot price of interest within that area. So that's the easiest solution, I'd say. But there is sometimes zone of interest, the way we have here on our chart, that are way bigger than usual, but offer high odds of reversal. In this specific area, we are seeing a 50 fib from a weekly level, another 38 fib from a higher weekly level, a strong key level with a rejection, and a big psychological number. So in this area, which is quite big, we'll go in more depth on this zone, I see an awful lot of strong confluences to generate a longer term reversal, or at least a significant reversal from this area. So for me, the chances of seeing a reversal in this area is strong and I want to trade it. But if I'm following my usual strategy, that zone is too big for me to take a trade. So what I'll be doing, I will scale my trade in the zone. And I'm going to break it down to you. What does it mean exactly? So in simple words, I'm gonna break my usual trade, which for example is a 10 lots trade. I'm going to fraction that trade in many smaller trades throughout the zone to make sure that if the price was to go through the whole zone and fail, it would be like losing one trade. But if any price within the zone reverse my area, because I think there is a strong chance that this occurs, at least I get a trade in and I'm profiting from it. So that's basically what scanning in a trade is all about. So we are looking at this strong area here, which is a very strong area in my opinion. Why? If we are looking at the fib first, the fib starting from that would be from this me show you. If you're starting a fib from there, which is the 17th of April, if we are taking the fib from this high there, and we are going to its low made right there, and if we are starting another one from the highest point, I'm taking these two fib because these two fib are the most relevant price action, and they've both been significantly respected throughout its downtrend. There you go. So I'm going there, making sure I haven't moved the up. Yeah, I thought so. Now we have our fib of interest, and we can come back on our chart basically. So what we're seeing now, we're seeing that big 50 fib and that big 38. They both have some strong price action, and therefore, being such big fib and having been respected on the way down on its way up, I want to respect the price action going there, basically. So I have no idea which one is going to be the most relevant one, but I do believe both have to be respected in a way. Therefore, I'm gonna have to account for these two confluences in order to try to get into a possible reversal. And that has defined a very, very big zone. Now, if it was just these two confluences, the trade will be pretty simple. The trade will be one spot price and a second one, and having a distance of around 190 pips on this one. They would be two separate trades, which is very possible to do here. But the thing is, why I am not considering this as two separate zones, it's because of the price action around here and that 1800 psychological level, basically. So, which means that in this specific case, I've seen the last time we've been around the area, multiple single rejection within the area and around that big 1800, which is our key level psychological reference, which means there's no way to predict in between if there will be some form of rejection, and if there is, which price is going to be the spot price to fully reverse the trend. So when I'm saying fully reversing, if you look back at this example there, actually it's quite clear. So if you are looking at this, we have first a single rejection leading to this move down, and that was over 300 pips. Then we've got deeper in, and I'm guessing it's the 95, yeah, 1795, as we've established now using the physical strategy around psychological level. $5 below is a good insight to start seeing some sort of a reversal happening, and I usually use the $5 below the big round number like 1800. So we've seen another 200 plus reversal. We've seen one on the 1800, 100 pips, and we've seen one at the top at the 1807, which is for us now our 50 fib, and we've seen one of 200 plus before coming back to the 1800 and generating that massive down move. So as you can see, a lot of small reversal, when I say small, they're still significant, but a lot of smaller reversal occurred around the area when a final big move to the downside occur. So for us is how best to profit from this big area without missing out. Because obviously I could make the choice of going on this early entry, covering the whole area as a one trade, and that wouldn't be wrong. But I don't think that is the best setup. Obviously, the best setup would be to go with the top and have the biggest risk reward. I'm guessing everybody can see the biggest risk reward is going with the latest entry, but there is a big chance of missing out on the trade. Or you could average it out and take the entry in the middle and hope that this is the best compromise. And again, this could be still missed out, or this could be going all the way to the top, and therefore having to account for this and reducing your risk reward. So what is the best way to trade that area without basically having to take multiple positions with multiple stop losses and getting them all out if it's going all the way to the top, or missing out if you're just trying to average it all within the middle of the area? Well, the best way is to scale in the whole possible area of interest. So if you go back to the multiple scenario, which we are going to look at now, first case scenario will be to enter the area at the first confluence, which I pretty much often, if not every time, do. When I've got a zone of interest, my first confluence is usually when I will enter the trade. But depending on what the recent price action has been around, sometimes I will push it past the first confluence to go a bit deeper, but that is usually when a lot of recent price action has messed around the area. So it will have been around here before tapping into it, and that is not the case here. So this is definitely something I would have an interest in, because this is my first zone of my first confluence in my zone of interest. But if you look at it, we have to be realistic on what the potential target can be. If I'm looking at this chart right now, I have to account for this rejection, which I think on its way up could play a big part as well in the move, and therefore making it even stronger that on the way down we do get a break retest of some sort and get some pullback in the area. So when you're looking at the setup like this, this has to be considered as a possible exit, and therefore be accounted for your risk reward ratio when you're looking at the overall trade. So if you're looking at this overall trade, we slightly therefore in the negative. That means the risk is slightly bigger than the reward, and that there is nothing you can do about that, because you have to first account for all confluences. Therefore the drawdown area has to be this way, and you have to account for the possibility that you might get a struggle past that price, and therefore you must take action, and that action leads to taking some profit. Whether it's a partial profit or not is entirely different. What you have to look at is the overall picture, and the overall picture is telling you that this setup is a negative risk reward ratio, and therefore is not the best setup. So, possible second scenario, which can be part of the first one, it is to split your TPs and get exactly the same entry, but leaving a fraction of your trade running to TP2. TP2, which will use exactly the same logic, where you get another possible zone of break retest where the price will struggle to go below, and therefore will have to pull your TP. By that time, if you're looking at this specific trade, the move up all the way down is getting awfully close to the 38, and therefore would be considered as the final TP for me if it was to be considered as a short, which it is actually. So, in a sense, now with the first entry as a possible setup, you would be looking at the average of these two entries and looking at the risk-reward ratio. So if you were to split 50-50 on both of these trades, I mean TP1 and TP2, you would be looking at a trade that is around the 1.5 risk-reward ratio, which is an okay trade, to be fair, on this zone. So that would be your possible setup for this specific zone. Nothing wrong, but there is a way to maximize the reward if this trade was to use the full depth of the possible drawdown. Also, well, you could be reducing the entry position there, meaning that if your full position was 10 lots and you were not putting your whole 10 lot on this entry, but splitting it throughout this, you will see that you would actually maximize your risk reward throughout scaling into the trade. So scaling into the trade basically means the deeper the trade goes, so the more the trade goes against you, the bigger your position gets. It's using very simple basic mathematics and statistics that plays in your favor. That means if I'm allowing the trade to go against me, as it goes against me, my position gets stronger, and that is often what occurs on strong area of reversal. The deeper we go, the bigger the odds of reversal occurs, and therefore, when it occurs, if it has pushed further, your position gets more rewarding. It's almost rewarding you for allowing the trade to go against you, basically, which usually is the opposite in a way. So if you're looking now at how we would do this, we would consider the position 1 as we've seen, but with a reduced initial entry. That means you wouldn't use your initial entry in full, but you would use just a fraction of what you would normally take. And that has multiple forms, and we will see it in various examples. But that means that if you were not to enter in full at the first confluence here, which is the 1788 38 fib, you would then enter onto another possible one, which would be the 1800 psychological level. And as I've said earlier, where would you enter that area? You would likely enter it around the $5 mark below that round number, which is usually a reference used as a possible reversal, and we've seen it with this one. So basically what you would do, you will you would copy that reversal and use that as your second entry. So now you will end up with one entry there and a second entry there. You see that second entry straight away has almost got a 2 risk-reward ratio, so a lot better. So that means if the trade was to go all the way there, not only you would be already in, but your next entry would make you a bigger reward compared to the risk you're getting. So that means that in essence, the position you're using on the second one doesn't have to be as big as the first one because the reward is getting better. So you're getting a bigger reward by risking less. And that is what the scaling is all about. And that is what is making it very useful on big areas. And if we carry on with this, we will go on to the next one. And the next one would be, if you were to let it play all the way, we will use the last confluence, so I will enter slightly below, and we will use the 50 fib as our last possible entry. And again, if you're looking quickly at the risk reward, we are 2.5 in the risk reward, meaning that if we were to have used an equal size position, let's say an even split, 3.3, 3.3 and 3.3, so a third of our position from the 10 lot, the first would reward you as much as your risk, the second one will reward you twice as much as the first one, and the last one would reward you on the first initial zone of a possible pullback 2.5 times. So now you're seeing, if you were to play it all the way, that actually that trade overall will reward you around 50% more than if you were to take only the trade on first entry. And that is why we are using scaling in on large area of interest to maximize first the reward you would get from an area, but also to not pass on a possible area of interest just because the zone is too wide to identify one unique spot price to take a trade from. So it has two benefits. The main one is not passing anymore on zones that are too big to have that spot price of interest, and makes life easier. And second, to get bigger reward from the area of interest itself.
Thanks for watching, guys. Don't forget to comment, like, and subscribe.